Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Genuine Parts Company Annual Report. Genuine Parts Company offers a wide range of businesses and services to its customers. In the Automotive Parts Group segment, the company distributes replacement parts for various vehicles, including hybrid and electric vehicles, trucks, SUVs, buses, motorcycles, farm equipment, and heavy-duty equipment. They also provide automotive parts such as brakes, batteries, filters, engine components, tools, accessories, and fluids. In addition to distribution, the company offers custom services like paint mixing, hydraulic hose assembly, battery testing, and key cutting. They operate service and mechanical repair centers for heavy vehicles and independent repair shops under the Napa brand. The company also provides online services through Napa Online, where customers can browse, purchase, and have automotive products delivered. The Industrial Parts Group segment offers a diverse range of industrial replacement parts and equipment, including abrasives, adhesives, sealants and tape, bearings, chemicals, cutting tools, electrical, facility maintenance, hose and fittings, hydraulics, janitorial, mechanical, power transmission, pneumatics, process pumps and equipment, safety, seals and gaskets, tools, and testing instruments. The company also provides inventory management services, asset repair and tracking, vendor-managed inventory, radio frequency identification asset management, gearbox and fluid power assembly and repair, process pump assembly and repair, drive shaft repair, electrical panel assembly and repair, and hose and gasket manufacture and assembly services. Overall, Genuine Parts Company offers a comprehensive range of businesses and services to meet the needs of its customers in both the automotive and industrial sectors. Unfortunately, I am unable to provide a response as there is no text provided. Please provide the extracted summary for me to generate a quick read overview essay on what has caused Genuine Parts Co. stock price to make no significant changes in the past year. Genuine Parts Company market capitalization of $16 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Genuine Parts Company holds a significant advantage in their industry. Genuine Parts Company trades at a higher price-to-earnings ratio of 20 times, and a higher price-to-book ratio of 3.67 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 3.6%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several factors contribute to an increase in revenue. The growing and aging vehicle fleet, expanding opportunities in electric and hybrid vehicles, and increased manufacturing activity across diverse end markets are key drivers. Additionally, shifts in global supply chains, rising demand for automation and robotics, geographic expansion, acquisitions, and net income growth also play a significant role. Furthermore, the depreciation and amortization growth is another indicator of revenue growth. On the other hand, revenue decline can be attributed to several factors, such as decreasing consideration receivable from vendors, charge of $151 million to cost of goods sold, depreciation expense related to capitalized software costs, and decrease in net sales from international automotive segment and industrial segment. It is essential for businesses to monitor these drivers closely to make informed decisions about investments, resource allocation, and strategic planning. By understanding the primary drivers of revenue growth or decline, companies can identify areas of opportunity and mitigate potential risks, ultimately leading to sustained financial success. The net income of the company experienced a significant decline between 2023 and 2025. In 2024, it decreased by 31.2% from $1,316,524,000 in 2023 to $904,076,000. The following year, 2025, saw an even more drastic drop of 92.7% to $65,945,000. The profit margins also underwent changes during this period. The gross margin remained relatively stable, increasing by 0.5 percentage points from 36.3% in 2024 to 36.8% in 2025. However, the operating profit margin and EBITDA margin experienced a decline. In 2024, the operating profit margin was 5%, but it dropped to 1.6% in 2025, representing a decrease of 3.4 percentage points. The EBITDA margin also decreased from 7.8% in 2024 to 7.1% in 2025. The reasons behind these changes are multifaceted and complex. Net income was affected by various factors such as uncertainty in global economic conditions, fluctuations in foreign currency exchange rates, increased debt levels, discrete charges, higher expenses, and ongoing investments. Profit margins were negatively impacted by lower net income, higher expenses, decreased demand for products due to comparative price decreases with competitors, and reduced customer purchasing power due to inflation or deflation, employment rates, and wages. The decline in net income and profit margins can be attributed to a combination of internal and external factors. The company's ability to adapt to changing market conditions and manage its expenses effectively will play a crucial role in reversing this trend. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is its ability to generate positive operating cash flow. According to the latest available data, the company achieved an impressive $890,762,000 in positive operating cash flow for the year 2025. This achievement is a testament to the company's efficient management and effective financial strategies. The generation of positive operating cash flow indicates that the company is able to cover its operational expenses and generate surplus funds, which can be reinvested or distributed to shareholders. This trend suggests a strong foundation for future growth and stability. The company's financial health has undergone significant changes in terms of its debt level and interest expenses. One of the most notable increases is in interest expense, which has risen from $96.8 million to $163.5 million between 2024 and 2025, representing a staggering 68.7% increase. This substantial jump in interest expense is mirrored by an increase in total debt outstanding, which has grown by $1.2 billion to reach $4.8 billion as of 2025. Furthermore, the company's total unsecured debt has also seen a significant rise, increasing from $4.3 million to $4.8 million. The commercial paper outstanding interest rate is another area that warrants attention, with a rate of 4.39% as of December 31, 2025. While this information does not directly impact the company's overall debt level or interest expenses, it provides insight into the current market conditions and the costs associated with borrowing. Overall, these changes suggest that the company is facing increased financial burdens, which may have implications for its future operations and profitability. The recent financial summaries reveal mixed results across various segments and regions. On the positive side, the industrial segment saw an increase in EBITDA of 4% and a rise in EBITDA margin by 30 basis points. Similarly, North America Automotive performed well with a significant growth in sales and gross profit, resulting in an expanded gross margin. However, other segments and regions did not fare as well. The International Automotive segment experienced a decline in EBITDA of $24 million, accompanied by a decrease in EBITDA margin by 90 basis points. This led to a lower EBITDA margin of 9.3% in 2025. Furthermore, the corporate segment reported an EBITDA loss of $357 million, accounting for 1.5% of net sales. Additionally, North America Automotive was negatively impacted by vendor bankruptcy, indicating that despite its overall growth, it still faced significant challenges. Europe and Australasia, although having a substantial presence in the company's revenue, did not have any specific performance metrics mentioned, leaving their performance unclear. Management is optimistic about the company's outlook, citing a strong global presence with over 1 million customer locations. They expect to capitalize on business trends in 2026 and anticipate separating Global Automotive and Global Industrial into two independent companies. The company will focus on meeting evolving needs through its products and services, investing in technology and supply chain capabilities to drive growth. Management is confident that revenue and earnings will grow despite weak market conditions, driven by initiatives such as gross margin expansion, cost control, productivity, and disciplined capital allocation. However, they also acknowledge key risks, including disruptions in global supply chains, foreign currency fluctuations, and constraints in credit and capital markets. Acquisitions and divestitures are significant business strategies that can impact a company's growth and profitability. In terms of acquisitions, our company has made over 50 strategic purchases in recent years. One notable acquisition is Benson Auto Parts, which was acquired as part of our expansion efforts. We have also acquired independent NAPA stores in the U.S., further solidifying our presence in the market. In addition to these individual acquisitions, we deployed $318 million for acquisitions in 2025, demonstrating our commitment to growth through strategic purchases. On the other hand, divestitures involve selling off certain assets or business units to focus on core operations. One proposed divestiture is the separation of the company into two independent, publicly traded companies. This move aims to streamline operations and improve efficiency by allowing each entity to focus on its specific strengths and goals. The company's commitment to rewarding its shareholders is evident through its consistent payment of dividends. Since going public in 1948, the company has maintained a tradition of paying out cash dividends to its investors every year without fail. This demonstrates a strong focus on shareholder value and a willingness to return profits to those who have invested in the business. The most recent dividend payout for 2025 was substantial, with $564 million paid out to shareholders. This not only reflects the company's financial health, but also its dedication to sharing its success with those who have supported it over the years. Concerns about inventory buildup and supply chain disruption are evident throughout the provided text. On page 84, a significant amount of $290 million in inventory acquired is mentioned, indicating a potential issue with inventory buildup. Furthermore, on page 87, deferred tax liabilities related to inventory suggest that there may be concerns about inventory buildup. Additionally, pages 8 and 9 highlight potential risks and disruptions in the supply chain. Supplier consolidation could limit the number of suppliers from which products can be purchased, while raw material shortages or manufacturing capacity issues could affect suppliers' ability to deliver quality merchandise. Delays or disruptions in executing a supply chain modernization initiative could also have a material adverse impact on business. The potential for supply chain delays or disruptions due to changes in international trade agreements, protectionism, or the imposition of tariffs is another concern mentioned on page 13. While these concerns are not explicitly stated as inventory buildup or supply chain disruption, they do suggest that there may be underlying issues with inventory management and supply chain operations. Overall, it appears that there are legitimate concerns about inventory buildup and supply chain disruption, which could have a material adverse impact on business if left unaddressed. That concludes the financial summary for Genuine Parts Company. Feel free to comment below, and I will be happy to answer them when possible.